I'm Diane Burley, Chief Storyteller here at Coveo, and this is the Ecom Edge, a space where e-commerce experts, practitioners, and strategists hold illuminating discussions about their approaches to scaling and gaining advocates in a landscape dominated by retail giants like Amazon and, of course, demanding shoppers. Hi, everyone. Welcome to another episode of the Ecom Edge, the first e-commerce podcast focused on how enterprise brands, manufacturers, and teams like yours can be smarter with data, technology, and resources to gain that very important competitive edge. I'm your host, Diane Burley, Senior Director of Content here at Coveo. While the pandemic has largely subsided, at least in the minds of consumers, if not epidemiologists, and if last week's gathering at an offsite is any indication, it's still brewing a little bit in the background. Its continued impact, combined with soaring inflation, has the retail industry reeling with uncertainty. Supply chain, while a bit better, continue to plague the industry. Goods remain out of stock, and there's no real idea when goods are going to be available. The cost of shipping, whether by land, sea, or sky, has skyrocketed. Achieving profitability under these conditions has been a real vexing problem in retail for some time. So I'm thrilled to introduce today's guest, Andrea Leigh, longtime senior executive of Amazon, formerly of IdeaClick, and now founder and CEO of e-commerce education consultancy, the Alum Group. Andrea, welcome.
Thanks for having me.
No problem. Profitability. What a novel idea. That's one of the courses that I signed up for when I got the email announcing your new company. I was really excited to hear what you put together. What inspired you to delve in that route?
Well, as it turns out, we all need to make money in e-commerce. So I think but it's a difficult path to figure out how to do it because you've got you've got a cost to deliver associated with online orders. And so, there's an intersection of our course is actually titled Mutual Profitability because there is an intersection of where the brand manufacturer is able to improve their profits and the retailer can improve their profits. And we have improved mutual profitability. And that's the goal, right? For everyone, we're in this business because we need to make money.
Yeah, but it hasn't seemed like that for a long time. A lot of the big companies out there have amassed, using venture capital as sort of their fuel, which has made it really difficult for companies that aren't backed by VC money and just can't just spend and spend. They have to turn profitable. So that's what makes your topic so interesting. There's been this other pressure that other people get to play by different rules, I think. Is sort of the way I look at it, since my family was a long time in the retail business.
Yeah, I couldn't agree more with that, Diane. It seems as though our instant needs sort of culture and expectation as shoppers has been pretty heavily subsidized over the last few years with, to your point, venture and external investments in a lot of these instant need and delivery service provider companies, last mile delivery companies. They have not yet kind of turned a corner on profit. And having worked on Amazon Fresh, many years ago, I'm intimately familiar with the economics, particularly around grocery delivery. And it's really hard. It's hard to get that right. You've got to have density and you have to have, large baskets and you've got to, there are a lot of pieces that have to fall into place to make that work. And something that I think is really interesting is that a lot of the retailers, even before COVID, but COVID certainly accelerated it as we were at home and shopping online more, they've all really scrambled to match and beat Amazon on delivery speeds. So, some retailers now promising as quick as 15-minute delivery for items, and it's at an enormous cost. And I think what is interesting is that we're starting to see some of the retailers do more to determine where the shopper is on what I like to call the immediacy continuum. So not everyone needs it right away. In fact, there's an interesting study by Coresight Research that talks about they surveyed shoppers to see what was most important for them in buying groceries online. And like the fourth most important thing was delivery speed. The things you would expect to come up before that come up, like has the assortment that I want, is priced competitively, et cetera. And so it's not, not every shopper needs everything right away. And so I think retailers are doing a little bit more to help the shopper self-select into when they actually need it to help them manage the profitability challenge.
When did you launch the mutual profitability course?
Yeah, this is one of our newer courses. It just launched last month. And again, we're really focused on mutual profitability. So
right.
Manufacturer figuring out how to make more money in the e-commerce equation and the brand.
And what has been the reception so far? Are you finding that companies, this idea of profitability is resonating with companies?
Oh, for sure. I mean, this is a course that I've personally been teaching for about 7 years to brands and brand enablers like agencies. And this is our most frequently requested topic because, it's hard to get it right.
Well, what was fascinating to me when I went through the coursework, you've created an e-commerce success framework. Maybe you can go through that and a little bit, and then I'll make a comment or two after that.
Yeah, so our e-commerce success framework is sort of the foundation for all the courses that we deliver, and it sort of lays out the building blocks for success online. And then we have courses that kind of address each of the components, each of the building blocks separately. But the e-commerce success framework, within that, items will be successful online and brands will be successful online if they have a sustainable cross-retailer strategy. So that's kind of the foundational building block, is you have to have goals and objectives and be thinking about how the different retailers interact with one another. So that could be assortment strategy, maybe providing some differentiation to circumvent things like pricing wars. That could be promotional strategy. That it could be advertising strategy, but really making sure that you've got a plan for how, which retailers you're trying to prioritize for what things and why. On top of that is proper and accurate item setup. So items have to be properly set up in digital catalogs. When we work with brick and mortar, we can often, ship in substitutions. We don't have to worry as much about that item data. But online, that item data is also often customer facing and shopper facing, so it has to be accurate. And in addition, it's often what the fulfillment centers, particularly for Amazon, are going to use to automatically receive products. Mm-hmm. So in order to make sure that you have the best shopping experience possible for the shopper, and in order to make sure products can be received, we have to have items set up accurately in digital catalogs. There's also some component of search engine optimization. There are factors and attributes about products that we need to include in order to help shoppers make a purchase decision and drive conversion. There's categorization that we need to make sure is correct to show up in the correct navigation structure, so that when a shopper, navigates to organic peanut butter, they see your product if your product's organic peanut butter. So that item setup is really critical. So sustainable strategy and proper and accurate item setup.
We could dish on that proper and accurate setup for some time, because in our universe, we're being a search engine with personalization and recommendations. I can tell you that's a big problem. The metadata is missing, the descriptive data is missing. There's just a lot of things that a customer is looking for is just not present, and that's a burden, which was interesting. This is one of the things I found interesting about going through it is, and I guess we know it, but I didn't know it, is how much the burden of creating that has shifted from the manufacturer to the retailer, because the retailers, they're the ones pushing it out there.
Absolutely. And I think I would argue that within the e-commerce model, a lot of burden has shifted from the retailer to the manufacturer. It's because these platforms operate in like a really self-service way. And so there's all these new responsibilities that brands and brand enablers now have to learn and develop skills and tools and technologies and all these things in order to be effective online.
All right, so in through two of them, and I know you've got three more, so I'll be quiet and I'll let you go through it.
So sustainable strategy, proper and accurate item setup, The next is financially viable. Items will be successful online if they're financially viable. And so they need to be financially viable for the manufacturer, of course. They need to make money when selling products online, but the retailer needs to make money as well. And that financial viability for the retailer is often kind of the responsibility of the manufacturer. They have to make sure that they're selling items online that are economically viable online. And if their items are not economically viable, they need to figure out how to make them economically viable. So, there are certain product categories and types that lend themselves very well to a cost to deliver model. Think about something that's very lightweight and has a high retail selling price. So the margin on that's going to be really high because the shipping costs are low. Whereas, and so if you think about like a pair of diamond earrings or something, that's going to have a really high margin online because it doesn't cost a lot to it's a very low weight item, versus if you get something like dog food or conventional dog food in particular, where you've got 20 pounds of product that might be retailing for like $20 or $30, and that's a really difficult product to make money on online. And so some products can be reconfigured in order to make them more economically viable online. So, if you have something that just has a lot of extra packaging or an extra weight that can be removed, or some extra touches within the supply chain that are potentially unnecessary, there are ways to the goal here is to reduce as many costs as possible between production of the product and the consumption of the product. And so that's what financial viability is. On e-commerce marketplaces, often the products that are less financially viable, they have algorithms that can deprioritize those, both in search results, on Amazon in particular, within advertising. Items can be ineligible for advertising if they're not meeting financial thresholds. And so that financial viability is a real critical building block of our e-commerce success framework, because if products aren't financially viable for the retailer, they might be ineligible for important programs, deprioritized in search results, or they might not be ordered at all. So, sustainable strategy, proper and accurate item setup, financially viable. And then the next piece of the e-commerce success framework is items need to be consistently in stock. And the marketplace model is a lot different than a brick and mortar retailer in that if the product isn't in stock, the marketplace is designed to sell the next best item, to push the next best item to the shopper. And so that product might not belong to that same manufacturer. So, it's that, and then in addition to, being less likely to promote one of your other products, the algorithms for some of these retailers, Amazon in particular, place a large penalty on products being out of stock. So if a product runs out of stock on Amazon, for example, it could be 4 to 7 days after the product's even back in stock before it regains its original position in search results. So it falls kind of to the bottom of the search results, and the algorithms deprioritize it. So there's a real tax on out of stocks online. And if you're out of stock, you're just simply not on the shelf at all. And unlike brick and mortar, it's unlikely that the shopper might not see the other items that you're offering. Like the shopping and discovery process is just a lot different.
Well, you also have no idea when an item that's, as a consumer, when you see something's out of stock, you have no idea when it might be back in stock.
Absolutely. So sustainable strategy, proper and accurate item setup, financial viability, consistently in stock. And then at the very top of the pyramid is receiving traffic and activity. And so that's really thinking about, we have all of our retail readiness building blocks in place. And so now how are we going to drive traffic and activity on our items? And that can be in the form of promotional strategies. It can be advertising and retail media. And it can be, driving things like reviews and engagement and, star ratings and Q&A and all of the things that help those items be more successful online. But really, that's at the top of the pyramid, because we have to make sure that products are in stock. We have to make sure they're financially viable, they're set up correctly. Like, we want to do all the work to set the items up for success before we start layering on traffic and activity.
So of those 5 items, which one do most companies do very, very well?
Well, I would say, I mean, it varies depending on the company. There are some, and also on the size of the company. So, for example, maybe a large CPG might struggle a bit more with the in-stock component because they're built for scale and they're built to send truckloads to Walmart of their product, right? And if you're working with an e-commerce marketplace like Amazon, they might be placing very small, frequent orders to begin with as items kind of ramp up. So maybe for a big CPG, that might be kind of a challenge area. The financial viability, kind of as we kind of mentioned, it can be more challenging for some of the more commodity and consumable items. So manufacturers that sit in consumable categories like grocery, health and personal care, and beauty may struggle a little bit more with that one because of the commoditization of their items. The proper and accurate item setup might plague a brand a little bit more that has just a lot of technical details related to their product, and making sure we get all those right across the whole catalog can be really challenging. So I think it depends, but I think the financial viability tends to be kind of the hardest one for brands, because you've not only got to worry about your own profit, and you have to factor in the cost of retail media and all these other things online, and all the new responsibilities you've taken on in accounting for the cost of all of those to really understand your total cost to serve. And then you also have to make sure that the retailer makes money.
What was really fascinating looking at your background is how many different categories you've actually been exposed to. It's sort of like to become a manager at McDonald's, you have to work the fry station and the shake and everything like that. I mean, did you start at Macy's? Was that one of your first e-com jobs?
I actually, it was a brick and mortar role, kind of working across the stores and learning a little bit about the different functional areas for their physical stores, and everything from kind of like the product development, assortment strategy, even security, really thinking about how the shopper engages with the store. So that was the early thing. But I think the experience at Amazon, I mean, it's a testament to their disinterest in category expertise, right? Like, they move people around categories a lot. They love to have those fresh eyes on categories, and they're a platform versus, they think of themselves as a platform versus thinking of themselves as a retailer. And so, more recently in some of their more senior roles, they're certainly hiring folks with either retail expertise or manufacturer expertise, but that's not traditionally, those aren't traditionally the profiles that they hire. They hire highly analytical folks that are really good problem solvers, and then they put a bunch of hard problems in front of them, like how to do grocery delivery profitably and that sort of thing. But I worked on Amazon. I was a category leader for a number of categories. I spanned everything from
babies too, right?
Baby too. I did baby hard goods and apparel. I worked on the fashion. I worked on grocery, kitchen, tools and home improvement, automotive. I really I even did kids and teens fiction print books for a while. So kind of spanned a lot of different product categories.
Is any one category doing it better than another in generally speaking, or are all of them about the same?
Well, I think of all the categories I worked in, I think kitchen was one of the ones, kitchen like hard lines was one of the ones that was the most dialed. And for a few reasons. I mean, first, the nature of the products lends itself pretty well to e-commerce. So you're dealing with products that maybe have like a little bit higher average selling price, so above the $20 mark usually. So you're dealing with like very small appliances and things that ship well online and have the margin to support that. But also that that category is a little more mature in terms of how they work with a cross retailer strategy. So if you take like a KitchenAid mixer, for example, if you go to Bed Bath & Beyond and Macy's and Amazon, you're not going to see the same mixer. It's different. It's not just colors, like they have actually different bells and whistles. And so that differentiation of assortment is a strategy that brands in that category have employed for a long time for brick and mortar. And that lends itself really well to online, because you don't have to deal with as much of the price matching. It's not as much of a race to the bottom. And that differentiation gives the shopper a reason to visit the different retailers as well. So that strategy has kept that category in a pretty good place for as far as e-commerce is concerned, that differentiation. So I think that's probably the one that I would say is the most dialed. And there are also some natural things about the category that just lend itself well to e-commerce. It's not a super seasonal category. It gets a little bit of a bump in the holidays and things, but it's not like toys where they're doing like 60 to 80% of the revenue in Q4, which is very difficult to plan for online. So it's a little bit more of a predictable forecasting model, and so that kind of combined with the economics and the assortment differentiation, I think makes it a pretty good category online.
So that price matching that you just mentioned is something that's really it's sort of a bane to a lot of brands right now. It's very hard to know or manufacturers actually, what your product is going to be sold for. Are you seeing a lot where they're fixing the price? They're saying, this is what you must retail it at. There's not going to be any discounting unless we call the shots. Is that happening a little bit more or less, or what's happening there?
I mean, there's always definitely not as much in consumables because the commoditization, like I think we certainly do see manufacturers in like electronics or even kitchen or baby hard goods or a variety of categories employ those kind of MAP, they're called MAP or IMAP or EMAP policies to kind of say all the retailers need to be in the same place. But those aren't very like shopper focused. They're not super shopper centric, because we want to be able to pass more value onto the shoppers if we can. So I think what I'm seeing more of is this assortment differentiation. And so we have seen kind of 3 levels of assortment differentiation. And by differentiation, I mean like the KitchenAid example where they've got a really different product sold to each of the retailers. And so there's an undifferentiated strategy, which is what a lot of consumer packaged goods companies engage in, which is just everyone gets the same like Maybelline mascara, right? And that is fraught with issues around price matching. And it can really hurt the profitability of the retailer because sometimes they even have to sell it below their cost to match someone else's promotion or rollback or whatever, which then puts a lot of pressure on the manufacturer. The next level would be like a partially differentiated assortment strategy. And that's where the brand is offering like somewhere between 0 and 50% of their assortment differentiated across retailers. And so that could look like maybe a coffee company gives their organic line to Amazon and their non-organic line to Walmart, for example. And then we see more of a fully differentiated assortment strategy. And that's where you're really looking at like the KitchenAid mixer example. Crayola is also a great example of this. They've got about 80% of their assortment that's differentiated on all the different marketplaces. So they're not selling very little of the same thing to all the retailers. And so that differentiation there are a lot of pros and cons of those models. Obviously, the more differentiated, the more complexity you have as an organization, the more cost. But the more you're able to circumvent some of that price matching, drive value for each of the retailers, and give the shopper, a reason to visit each of the retailers.
Tell me a little bit about in your rich framework or the rich format, I think framework, I don't know what you call it. You go into different ways that the relationship is definitely changing between the brand and the manufacturer. And it's a great time for them to renegotiate, who's going to be doing what? How are you going to handle returns? How are you going to handle breakage? How are you going to handle shipping? How are all these things going to be, things that are really the impact of the profitability? So maybe you walk it into that a little bit, some of the suggestions of where people might approach the relationship differently when it comes to renegotiating.
Absolutely. I mean, I think the biggest change we've seen in the last few years in working with e-commerce marketplaces is the introduction of retail media. Mm-hmm. And so, even just a few short years ago, there wasn't retail media on all of these e-commerce platforms. Amazon was starting to dabble in it, like 5-7 years ago. But it wasn't an enormous cost yet for the manufacturer. And so the traditional terms that manufacturers had with these retailers was to include some small accrual or amount to cover marketing. And that was, for the retailer to do marketing on their behalf. But now with the introduction of retail media, a lot of these brands have started kind of double paying. So they're still paying those old accruals that they're grandfathered into, but now they're also responsible for retail media budgets on top of that. And so that's where we really recommend the manufacturers kind of hone in. Like, are we still getting value for these marketing accruals? Does this still make sense? So that's an important piece of renegotiating terms. The other piece of renegotiating terms is looking at where are we paying to have the retailer support us when we should just solve the problem. So that's really thinking about, okay, if we're paying a damage allowance, for example, of like 2 or 3%, is there a way to just make sure our products don't get as damaged and try to improve that out and improve it and then like lower the term. So renegotiating terms is the first part of the RICH framework. So RICH stands for R is renegotiate terms, I is invest in win-wins, C is carefully optimize advertising, and H is heed the root cause. And I'm happy to talk through each of these, but the first one, renegotiating terms, is really focused on each of those individual terms and where can we improve the underlying situation and then work to renegotiate with the retailer.
Well, if we go right to the end, heed the root cause. How many of these companies are using extensive amounts of data to try and figure out what the root cause of these issues are?
Yeah. Well, I mean, with some of the retailers, it's pretty easy to know what the root cause is because the retailer might charge you for it. So they might charge you a chargeback or a penalty fee or a shortage. You might get shortage claims, which means that the retailer thinks you shipped less than you invoiced for. And those are all clues. Like if we are being investigative reporters, those are all clues that help us figure out, what the culprit is and where the issue is. So heeding the root cause could be looking at things like damage allowances and literally just looking at actual damage rates. There are a lot of things that drive costs in the retailer P&L. Customer service is another great example. So if a shopper buys something online, receives something they're not expecting, or receives something that's has some sort of problem, a great example of this is clamshell packaging. So when I ran toys for a little while, we would often get complaints from customers that they would receive the product with the clamshell packaging, and the clamshell packaging would be pretty banged up because it doesn't ship well. And so and usually for toys, you're giving things as a gift. So you don't want that, right? And so really thinking about how can we do some custom packaging for online, or how can we adjust the clamshell so that it's, less of the plastic is exposed, or that it ships a little bit better. But there could be a number of things driving customer service contacts. And when we want to investigate, we want to look at things like customer reviews, what are shoppers saying about the product and how it's showing up, et cetera. We could also be looking at things like freight. So where do we have extra weight in products that we need to remove, or extra packaging that's unnecessary? And then kind of going back to those chargebacks and shortages, what clues can we get from those about how we're being kind of dinged by the retailer for various issues that, that will help kind of some of that profitability as well.
Amazon came out with their earnings report yesterday, and I think they did a little bit better than the previous quarter. Can you make any comments on it? Any insights?
Yeah, it was a really interesting. Quarter. They had a really good top line story. They beat their top line, or at least the analyst expectations of their top line revenue by $2 billion. They were up 7% year over year, but more importantly, they gave a really rosy outlook for Q3. So they think that they're going to do, 125 to 130 billion, which is higher than what analysts said, and it would be double the growth rate they just experienced. And there's been a rumored second Prime Day that might go live this fall, so that could be potentially what's bolstering that. But when you look at the mix, this is the thing that I think is most interesting about their earnings. I think it's most interesting every quarter because it keeps heading in this direction. I like to look at the percentage of the business that is services and the percent that's retail. And retail has fallen below 50% of the total net revenue for many quarters now. So they're only 46.3% of their business is online and physical stores. And the rest of it's all services, third-party seller services, AWS, advertising, subscription services. And those segments of the business are growing faster than retail. Retail was actually down 4.3% year over year. So I think that's an really interesting story. The profit piece was interesting as well. They posted losses of $2 billion, but it was largely driven by their Rivian and the stock value of Rivian going down. So it's just like a paper loss. It's not a real loss, but it did sort of mask that even if you back that out, they would have been less profitable than many, many quarters. They would have been a little bit less than $2 billion in profits, but they usually range from 3 to 14 billion per quarter. So it was still lower, and they're just like overcapacitated and overstaffed. And like, I think they mentioned on the earnings call, they'd shaved about 100,000 employees off of the workforce, and they're still kind of trying to grow into the capacity that they overbuilt for COVID, and had some commitments on leases and things that they couldn't get out of. So I think it's going to take a little bit for the dust to settle over there. And it's not unlike other retailers. I think a lot of retailers are dealing with similar issues of like, how do we right-size our operations to the post-COVID demand? Because no one really knows what that's going to be. But that was interesting. And then I think the third thing that was really interesting was the cash flow was negative. And Amazon is always optimized for free cash flow. They've always been a very cash-rich company, even if they're losing money. And to me, that just says it leaves them less wiggle room for investing in innovation. And so it's just going to be kind of a slog for them to dig out or I guess grow into the increased cost structure that they've built.
So is this a harbinger for everyone else in the e-commerce, or is it an opportunity?
Well, I think it could be an opportunity, because if they don't have as much time and energy and resources to spend on innovation, someone could get in there and figure out how to do a better shopping experience, or do something that's a little bit more disruptive. But they also didn't talk about on the earnings call some of the other things they're working on in the background. And it's no surprise, like the Q&A is usually largely driven by analysts, and they really care about the profit and the financials. But they did just make a huge acquisition in healthcare, and they've been quietly doing a lot in healthcare all through the pandemic. If you look at Crunchbase and the types of companies they invest in and things like that, you can see that they've been pretty busy there. And that's an industry that's super ripe for disruption. And if anyone can do it, Amazon can.
I have one last area I want to cover before we say goodbye for the day. The retail media. I mean, it's you've mentioned it a couple times now. How strong is this? Is it an opportunity for other companies to get into it? It used to be co-op funded. There used to be co-op dollars. There still is co-op dollars. So there's a couple different programs out there in terms of how you can be making money off selling advertising. But you also have to be careful with it, because you can end up pushing products when a customer doesn't necessarily want you to.
I think it's interesting. I mean, there has been just, it's like we're having another boom of some kind with all of the different e-commerce retailers launching retail media platforms. And there are a couple of reasons for that. I mean, the first is they now have audiences. So there's enough of an audience to monetize. And the second is, well, I guess there's three big reasons. The second is that there's technology available. So this didn't exist before, and now there is some more off-the-shelf stuff you can buy to implement a retail media platform on your e-commerce site. But the third is, for these e-commerce retailers, this is a very critical and necessary offsetting revenue stream to the losses that they experience in e-commerce. It's really hard to make money like we mentioned, in the cost to deliver model, and particularly if you mostly sell consumable products. And so this is a really great revenue stream to help offset some of those losses. And retail media is very attractive to marketers, because it seems like a closed loop, right? Like you can directly tie your spend to sales on that retailer platform. Now, I think that's oversimplifying how retail media works. something like 80% of shoppers begin their purchase journey online. But for a lot of manufacturers, they're still doing only 20% of their business online. So we know that a lot of the engagement in retail media ends up with a store purchase. And so it's and you don't know like which retail media platform did the shopper see the ad on, or so I think it's a lot more complicated than it seems. But it's also super fragmented, but it is really attractive to advertisers.
Well, it's good incremental revenue if you can get it right.
Absolutely.
Andrea, thank you so much for joining us this afternoon on the Ecom Edge podcast. And thank you, everyone else, for joining our community. Thank you for listening. To hear more, subscribe to the Ecom Edge podcast today. Listen to us wherever you get your podcasts.